Hi everyone, I'm Nikki Jovicic from LookUpStrata and I'm also Managing Director of Tower Body Corporate, which is a body corporate management company on the Gold Coast. We're joined by Jenine Garcia, Business Development Manager at Lannock Strata Finance. In this national webinar, we're talking about how Strata Finance can assist with both the remediation of strata defects and renewals and transformations in your building. Janine will discuss the importance of finding the right funding for your project, and she has some examples of amazing past projects to illustrate what you can do. As always, at the end of the presentation, we'll have a discussion and cover some relevant Q&As. Now, before we begin, as always, I'd like to mention that the information contained in the session today, including the discussions that arise from submitted questions and also chat conversations that happen, it's not legal advice and it should not be relied upon as legal advice, and you should seek independent advice before acting on the information contained in the session today. We thank Janine for being our very first presenter for 2023. With over 10 years of sales and operational experience in the financial sector, Janine leverages her in-depth knowledge to help Lannock Strata Finance clients achieve the right outcome for their next strata project, whether it's funding cladding rectification, defect rectification, repairs and maintenance, litigation, insurance, or strata asset renewal and transformation. So obviously she's the perfect person to speak to us today. This is our second webinar session with Lannock Strata Finance. I was joined by the founder and CEO, Paul Morton, in August last year, and that webinar was about meeting financial obligations during challenging times, and I'll provide you with a link to that session when we send the email out later today. So welcome, Janine. Thanks for being here.
Thank you, Nikki. It's certainly an honour to be the first person presenting for the year, so I do feel a little bit special. So, okay, well, thanks so much for having us today. I'm just going to share some information with our audience regarding building transformations and defect remediation. So it's great to be here and be able to speak with you all. We know that strata can be challenging, confusing at the best of time, and what we've found especially in recent times, the last couple of years, there's several things happening at the moment that are intensifying these feelings of confusion and challenge for owners and strata managers also. On top of the interest rates, price fluctuations for their asset, lots of things happening in the broader marketplace that are impacting strata as well. But today I want to speak about things that are specifically impacting the strata sector, especially and the opportunities people are taking or owners are taking to use some of the challenges they're facing to transform their building. So first up, we can look at what is actually occurring in strata sector at the moment. So if we can start with cladding first, most people will be aware that the Victorian, New South Wales and ACT state governments have introduced programs to rectify cladding. In these instances, it's generally on the buildings that are worst impacted from the cladding. So there's still a lot of buildings out there who do need cladding rectification but won't be included in those programs. The programs vary from state to state, but it's great to see that, and it's certainly we are absolutely involved in the New South Wales program. We are the loan servicer for that, so it's great to see that those buildings are being attended to. Queensland, South Australia, WA state governments are yet to introduce programs to rectify cladding, so we still do see some inquiries from those states as well. Defects is certainly another important problem that has impacted the marketplace. What we're seeing are situations where OCs are first pursuing litigation, but quite often end up addressing the repairs themselves. We sometimes see OCs who pursued litigation, but then after a couple of years, they found the developer has been declared bankrupt, so then they need to finance the defects themselves. But we also see OCs coming to us without pursuing litigation for whatever reason. They've received advice not to. They just want to proceed and get it done as quickly as possible. Litigation is something that we would help with also, but certainly the defect rectifications are something that we're seeing a lot in the marketplace. Fire safety is another one. The fire department's been very active out there assessing buildings and issuing fire defect notices. The problem is for owners corporations, when they do get those notices, they have a date by which it needs to be completed. Quite often they can't manage to save up the money or implement they can implement a special levy, but get the money prior and the work's done prior to that date noted on the fire safety order. So fire orders have been one of the reasons that we have seen uplifts within buildings. Building transformations, owners have said, well, we need to get these works done, so let's do this and that and this at the same time. So they are taking the opportunity to capitalise on value add on those necessary works. Most people are familiar with Sky Tamarama, or New South Wales people will be. Sky Tamarama is a building that we finance in Tamarama, that they've done a massive project to uplift that building, but we'll talk about that a little bit later as well. So it's not just those things, but even when people are doing general remediation works to their building, owners are starting to contemplate their investment, how they can value add when they're addressing those repairs. Things like water ingress, roof repairs, concrete cancer, sometimes there's an opportunity there to uplift the building, the facade especially, the roof, and they do value add the building. Sometimes by just doing the remediation itself can uplift the building and certainly add to the value of owners' assets. This year and last year, we have seen severe weather events impacting the sector off the back of COVID that has caused delays, and we'll talk about that as well. We have seen several severe weather events, especially flooding, and that's forced the hand of owners who've been putting off repairs or in the midst of saving towards them. What we've seen happening, and this is always the case anyway, is that those weather events have increased the scope of works that need to be done and therefore impacted the cost of works that need to be done. And they have been increasing. Those costs have been increasing quite rapidly. Owners are often quite shocked at the increase in the quotes that they've received perhaps 6 months ago. Certainly beyond that, 18 months to 2 years ago, we do see them quite surprised at exactly what a big increase there has been in the cost of the works they need to attend to. Insurance has been another big issue in impacting the marketplace at the moment. This isn't just a local problem, it's a global problem. There's been a big shift in the attitude of insurers when it comes to the maintenance and general upkeep of buildings in the strata sector. Recent conversations I've had with brokers have revealed that up to 40% of strata clients are facing non-renewal of their policies if they do not attend to repairs. So that is certainly massive. It has really, really impacted buildings who've ignored maintenance that they should have attended to previously. And we've also seen a broader understanding of the options that are available to owners in order to address their repairs. So a capital works fund or sinking fund and special levies have traditionally been the way forward in strata, and this has been adequate in the past, sensible and reliable, if limited, way to go. However, we have seen massive emerging challenges in the strata sector, all things from building defects, inflation, supply issues, changes in legislation, decreased availability of trades, a lot of different things impacting the marketplace. And all of these things have contributed, as I mentioned with the other two things, to increased costs in completing work in the strata sector. So whilst owners corporations and body corporates might still aim to have a capital works fund, and they also address small issues with special levies, it's just not practical or even achievable for many owners to cope with a kind of increase in levies that they would need to save up in a capital works fund to address the kind of works that they're seeing that they have to complete. So I've watched other webinars where it's been suggested that a healthy capital works fund is the best way to address all upcoming issues. And in one instance, the Unilodge building was actually quoted as an argument for increasing your capital works fund. But when we look at the Unilodge building, that's a multi-million-dollar project. For owners to have put away millions of dollars in their capital works fund in anticipation of that project, it's just not a practical or efficient scenario. So it's certainly not something I would be recommending owners to do. From a financial point of view, it would be an ridiculously expensive cost of funds for owners. Whether you're an investor, an owner-occupier, the question must be asked, how else could I use those funds? You know, I don't want to put away $200,000 in the capital works fund of my money for the next 5 years to account for a just in case. That money can be used elsewhere. The same can be said for many buildings, not just Uni Lodge. We have seen lots of examples of unanticipated works that the owners couldn't have anticipated or saved for in their capital works fund. So all of these things, coupled with the education managers and owners to the financial benefits, have contributed to a changing mindset towards strata loans. So we can look at the next slide. The greatest financial challenges that we are seeing for owners corporations at the moment, as mentioned, insurance. Underwriters and reinsurers are becoming increasingly risk adverse. There has been much more rigour applied in assessing annual insurance premiums. In many instances, we've seen massive increases to premiums for buildings. This has severely impacted owners and their ability to pay those premiums. And again, something that really couldn't have been planned for 2, 3, 4 years ago, because it has been quite a sudden increase. Supply issues, several reasons for this, and it's not only Australia that has been impacted, it is a global problem, but nevertheless, we are quite remote and we do rely extensively on products from overseas. We're subject to global supply chain issues, and a shortage in supply always drives up prices. This looks like it will be an ongoing problem, and there's nothing that I can see on the horizon that will change this. So that has certainly had an impact on prices as well. Inflation, we're all aware of inflation, everybody's least favourite thing. On top of the cost increases that we've seen from the COVID hangover, which I'm about to talk about, and inflation and supply issues, inflation has certainly increased cost of works for people. And I've got there on the slide that concrete alone saw a 40% increase in cost in 2022, which is an amazing statistic. So, but I have had that, and I couldn't believe it myself, but I have had it confirmed by several different people in the sector that yes, in fact, that did happen. The COVID hangover, so we're all very aware of the couple of years that we've just had, 3 years, I think it is. Works have been shut down on many sites over the last couple of years with the lockdowns for different LGAs. And that's caused problems in securing contractors. And then once the contract is secured, getting the works underway, because there is certainly a backlog of work. Procrastination, nobody wants to spend money that they perceive they don't have to. And it's something I see as it's not uncommon. I'm sure a lot of strata managers see this too. It's not uncommon for owners who are not directly impacted by maintenance issues to not want to proceed in addressing them. It's a problem that's existed in strata for a long time, and it has been compounded by the issues that we've just talked about. So in New South Wales specifically, we have seen the recent legislation, the Design and Building Practitioners Act, which has had a very big impact on remediation works in New South Wales, and it has increased costs and also contributed to a lack of contractors available in the marketplace. So this is because plans are now needed to be signed off by a registered practitioner. There are a shortage of regular practitioners in the strata sector because some people didn't want to become registered practitioners. Engineers and architects and others in the sector are overcompensating if they are a registered practitioner and over-engineering their works to cover themselves. So that has just the cost of getting those registered plans in itself has added to costs, but with the over-engineering, the over-designing of things, that's contributing to increased costs for owners also. Again, a problem that will likely right itself in the fullness of time, but it's absolutely having an impact right now. Okay, so we move on to some good stories, building transformations. As I mentioned previously, owners who are addressing pressing works can often take the opportunity, sometimes not even deliberately, to turn those works into a building transformation or an uplift, as we call it. We see a lot of examples happening in Sydney, especially the eastern suburbs, where people are quite savvy and they know that if they do these works to the building, they're absolutely going to benefit from an increase in the value of their asset. But we're seeing them happening in other places too. I've got a couple of examples for you today. One of them is in the western suburbs of Sydney, another one's in Perth. So we are seeing them happening all over the place. So most people are familiar with the Tamarama building, which I previously mentioned. I've got one in Liverpool that I'd like to look at, and also one in Perth. So this is our Tamarama building. That's a list of the works that have been completed there. It was a very clever concept by a very clever lady on the committee. They had a very big fire order bill on their building, and they said, well, this building is in a beautiful spot. It's a little bit of an eyesore. It does need a lot of work. Why don't we take the opportunity to uplift the building, which is what they've done. And you can see there, that's just some of the works completed, because it has been a very, very big project. But they did their fire safety upgrade. They've added 2 levels of underground car parking, an extra elevator. The big thing with this project, and why it's such a big project, is that they did add 2 penthouses on top of the building. And they're on the market at the moment. So the sale of those penthouses will pay back most of the loan, or a bulk of the loan that they've had to take for this building. So I've just got some other pictures here to show the before and after. Sky Tamarama actually does have the penthouses for sale, as I mentioned, so anybody can Google that and have a good look at the penthouses. They should be giving me commission for that, the real estate agency. But it's a nice site to look at, actually. So another one we've done is a project in the Liverpool area. This is a much more modest project. The project cost was $1.5 million. The works completed included rendering, painting of the facade, stairs and balconies. I've listed them there for people to see. They've seen an approximate 25% increase in the value of their assets since completing these works. So you can see there from that picture the works that have been done, the new letterboxes, the painting of the facade, the landscaping, new electric front gates, which made it a security building, fire safety upgrade, the glass balustrades there. It's a really good project. And it's in an area where a lot of the other buildings are quite run down around it. So it's really a standout building now in that particular area. There's some of the photos from construction period. You can see all of the work that's gone in there, the new safety, the fire equipment there, new letterboxes being installed.
There's just a question on that too, Janine. Sorry, just to ask how many lots are in that. Is there like about 30 or something, or?
In that particular building, there was 36 lots.
Okay, thank you.
Yeah. So this is a project that was completed in Perth. This building had 18 lots. It's a much more modest cost of the project. It was $250,000, but they've done painting of the facade, the stairs, balconies, repairs to the roof with water ingress problems, installing new safety lights, downlights, floodlights, NBN conduits, so it's ready to go. New carports. It was a really good project that did uplift the whole building. And they've seen, since the completion of the project, an increase of approximately 20% in the value of their asset. And their current prices, so that includes the downturn we've seen in the marketplace in recent times. So there's just some pictures of the works being completed during the construction phase. Unfortunately, I haven't got an after photo for that one. So if we look at how a strata loan can ease the burden for owners, first up, it is really good financial sense. We've talked about all of the increased costs in the marketplace. One of the key points is a contractor will not let an owner's corporation sign a contract until they have the funds available. So if you're waiting to collect a special levy, sometimes owners will come to me after 6, 12 months, the levies haven't been collected, or the levies have been collected, but the cost of works has gone up in the meantime. So they will come to me for a loan at that point in time. What happens then, because the cost of works has come up, that in order to avoid the interest that they would have had to pay, they've cost themselves more in the increased scope and the increased cost in the meantime. So a loan does also provide flexibility for owners. Owners can choose a longer term, anything between 1 and 15 years. If there's a building where there's people on fixed income or are unable to cope with too big an increase in their levies, then I always suggest for them to go with a longer term, go with the 15 years. Keep the levies as low as possible, make it easier for everybody in your building to be able to account for those additional levies and pay the loan. Because we also have a payout with no penalty. So if the OC can afford to, during the term of the loan, they can pay that back in small chunks. So if they take a 15-year loan and then after, say, 18 months, 2 years, they find that they're able to do a small special levy and pay off part of one of their tranches, they can do that. And what happens over time is it won't be a 15-year term. It may only end up being a 6 or 7-year term. So it just gives them much greater flexibility.
So can I just confirm, Janine, Michael's just asked, excuse me, if you can advise at the maximum term, so the 15 years is the maximum term?
15 years is maximum term.
Okay, thank you.
Yeah. So a strata loan too, and for me, this is a really big one. It is the ultimate user pay system. So one thing I do here when I go to AGMs where I'm talking to committees or owners is I get complaints from owners of the past neglecting to attend to maintenance of their buildings. So we see many scenarios where the current OC or body corporate are having to pay for the neglect of owners past. The beauty of a strata loan is it is the ultimate user pay system. Because the loan is to the owner's corporation, it's attached to the lot and not the individual owner. So you pay for your share of the cost of the works for the time you're an owner in that building. If you sell during the term of the loan, the cost passes on to the new owner of the lot because it is attached to the lot. Often people have said that a sinking fund is the only fair way. It's not. They're wrong. A strata loan achieves intergenerational equity far more effectively. Now, some owners have said, well, it's just not fair. It's not fair to the new owner. Well, is it fair to the current owners that they're paying for the neglect of the past? So it is fair. If you're living in the building, you're paying your portion. If you sell from the building, you're walking away from that loan and it's not impacting your finances moving forward. You're not carrying forward a debt into your next property or the property after that. Because if you attach it to your mortgage, that is absolutely what happens. So owners do benefit from the loan for the duration of their ownership. So when we look at a capital works fund versus a loan, we did discuss this a little bit earlier. Capital works fund is absolutely a very expensive cost of funds to have that money sitting there when you could be using it for something else in your life, to put against your mortgage, to put towards another investment property, to pay for the kids' school fees, to upgrade your kitchen, whatever you want to do with those funds. It is an expensive cost of funds. So special levy versus a strata loan, what's the real cost to owners? Generally, we find that when the cost per lot exceeds a few $1,000s, people start to find it difficult to put their hands on that kind of money. So what do? They can add it to their mortgage. They expose themselves in that instance to a long drawn out intrusive credit assessment process. And as I said, the bigger the special levy would be, it's a debt that they do carry forward into ownership beyond the ownership of that current property. There'll be people who are at their maximum LVR for their mortgage. They don't have the capacity to service a higher debt. Perhaps they don't meet the debt to income ratio for increased borrowings from their bank, from their mortgage provider. There's a lot of different ratios that the bank will look at, and not everybody is going to meet that criteria. I've heard managers and owners say, well, they'll have to sell. And I've seen scenarios where upon selling, remembering that they're selling an asset that is in need of maintenance, so their market value is impacted, they then need to pay the special levy that's already been struck. This impacts that particular owner's ability to purchase a new property moving forward. It impacts their LVR for their new borrowings. It impacts what they're able to afford. It impacts their quality of life and their quality of accommodation or their investment portfolio. It's a heavy price to pay. So I really hate it when I see that. I really hate it when I see people say whatever they can sell. There's a better option. There's a better, fairer option that isn't going to severely impact this person's life. So sometimes people will go to their credit card. They don't have a choice because the majority vote has been let's go special levy. So they access the funds through the credit card, which is a very expensive cost of funds. We talked about savings that they may have aside for any other personal reasons. There's always a cost of funds. People look at the interest rate of a strata loan, and we're talking about the truth of the interest rate. People look at the interest rate and it is a very transparent cost. They see it there. They think, well, 10%, that's a lot. I don't want to pay 10%. But it's the cost of doing business, and everything in your life has a cost. If you go to funds that you've got in your bank account, if you go to funds in your mortgage, if you buy a sofa, if you get a car, there's always a cost. It's just hidden. You don't see it. So it is very transparent with a loan, what the cost of funds are, what the cost is going to be. So people naively assume the cost of the loan is the interest rate, and other forms of funding have zero interest, but nothing's further than the truth. As I said, all forms of funding cost money. I see so many owners corporations in an effort to avoid paying interest at all costs, actually cost themselves money because they have perceived at the beginning of the process that a strata loan is more expensive. Beyond this, you have to consider the after-tax cost. It's certainly relevant for investors. It's not a matter of the loan equals 10% capital works fund or equals 0%. It's always a little bit deeper than that. It's always a little bit more than that. And what we'd just like to see is people reach out to us, people talk to us, have a think about those things, speak with your tax accountant, really consider how much funds are costing you. The real issue is, what is the return on your investment? And that's what we'd like people to think about. So the strata loan interest rate also is relevant to the marketplace. It is an unsecured loan. It is a loan to the owners corporation. It's a comparatively smaller market than the mortgage market, which is what most people compare it to. There's no credit assessment conducted on individual owners because the loan is to the owners corporation. There's no personal financial information gathering, no mark on your credit file, no impact on your ability to secure other personal finance. So that, I find, does ease the burden on owners. That makes it much easier process, very accessible funds in order to complete these works, way less intrusive. It really does ease their burden. So we have been extremely busy given the changing attitudes towards strata loans in the marketplace, all of the things that have made works more expensive. We have seen very busy times here at Lannock. We had to increase our staff in order to keep up with demand. And even though we've always serviced nationally, we now have a new BDM in Queensland, and we've added another BDM to Victoria. We've had George down there for a couple of years now, and the Victorian people will be very familiar with him, but he's been joined recently by Josh. Here's our team here. This is our BDM team. So there's obviously me, Michaela. A lot of people in New South Wales are familiar with Michaela. She's been around strata for quite a long time, considering she's very young. And she's amazing. George has been in Victoria for a couple of years now. And a lot of people know him. He has certainly made a massive impact down there. Josh has just joined him in Victoria, and we have Jason, who's also joined us. We're very happy to have Jason joining us in Queensland. Again, a lot of people are familiar with Jason in Queensland. So we'd be very happy for anyone to reach out to us with any questions they may have from today, explain a little bit more in a little more detail how we may be able to help you or one of your clients.
Excellent. Thanks, Janine. That was wonderful. Thank you so much. We've had lots going on in the webinar chat while you've been speaking, so obviously lots of interest there. So what we might do, I'll just stop slide share so everyone can see your face while you speak to them. And maybe we'll go on to some of the submitted questions that we've had, but there has been just a really quick discussion happening right towards the end there. And the reason that I'm bringing this one up is that when I spoke to Paul last year, he did go into quite a bit of detail, and I'll link to that section of the session as well. But I thought you'd like to comment on it as well. And it was a question from David saying, surely a new buyer will see the loan and they will offer a lower price to cover the cost of the loan. And then Aaron's jumped in and said, the loan is being paid via the regular strata fees, therefore wouldn't a buyer just assess the property in the context of higher strata fees, not the loan itself, as it is essentially irrelevant to them? So did you want to put a comment on that at all?
Well, that is what we say. I do get that question a lot. People are very nervous that there is going to be a loan attached to their loan. So, but what Alan said is quite true. People look at what the increase in their levies are. So it depends what's happening in your marketplace, in your suburb at that point in time. Perhaps your levies aren't that high. Perhaps the building next door, the levies are lower, but they've got a $30,000 special levy that's going to fall due, and they've got a series of special levies that are due over the next 12 months or 6 months, whatever. So it's really relevant to your marketplace at the point in time. It's not something that we see as impacting prices. Yes, you may have slightly higher levies because there is a loan to pay, but you've got a building that's presented in its best condition. So they're not buying into a building that's a little bit run down, perhaps the roof needs work, perhaps this is happening. They don't know what is happening in 6 months. So it's a risk assessment that the owner has to make at that point in time. Yes, there's a slightly higher levy here because I have a loan that I need to pay, but the roof's been done, there's no water ingress, the building's been uplifted, there's no concrete cancer, the fire defects have been attended to. So,
it has insurance.
Absolutely. Absolutely. It has insurance. That's a big one. Yes.
Actually, just on that point too, you mentioned that statistic, which I was a bit blown away by, the 40% of buildings at risk for non-renewal because of not being able to tend to their repairs. Is that a national statistic, or was that state specific, or can you just maybe put some clarification around
the brokers I was speaking with were in New South Wales. However, insurance is very global. So we don't use, when it's not a local market, it is a global market. One of the things, and I think it may have been a LookUpStrata article I read, that has impacted insurance was the collapse of the building in Miami, which you wouldn't think would affect somebody in Liverpool, but it absolutely is, because insurance is a global market. So even though those brokers I have been speaking to are Sydney based, I would imagine that that is a national statistic.
Okay, thank you. That's great. Okay, so we'll go to some of the submitted questions. So we had a question come in from Carol from Queensland, and she asked, can the committee proceed with a strata loan without the lot owner's approval? So how do owners ensure all options have been explored prior to considering a strata loan? And how can we be confident the cost of the required works is the body corporate's responsibility and not the lot owner's responsibility?
Okay, so the committee cannot proceed with the strata loan without the owner's approval. You're in Queensland, Carol, so it depends on what module your building is, but it is at least a majority vote at a general meeting. So the owner's corporate, the body corporate in Queensland would need to proceed to a general meeting, and it would be a motion on the agenda that you would vote on. So it has to be at least a majority vote, depending on your module, perhaps 75%. But no, to answer your question, simply no, they cannot, the committee cannot proceed without lot owner's approval. For owners to ensure all options have been explored prior to considering a strata loan, that's really one for your committee or your strata manager. We generally find there has been quite a lot of research done into the most viable options for your body corporate before they're proceeding to a general meeting. So sometimes I'll get to a general meeting and some of the owners haven't actually reviewed the material that's been sent to them before. But I generally find that that has been done. But again, question for your strata manager. And how can you be confident the cost of required works is a body corporate's responsibility? Again, that is something for your strata manager. Sometimes it surprises me a little bit what I see is owners unaware of what they're actually liable for. They don't realise that they're liable for upkeep of common property. But yeah, I would absolutely suggest you have a chat with your strata manager for that one.
Excellent, thank you. And we had one from Paul from Victoria, and he was asking, our owners corporation is undertaking a defect remediation project. It's been financed through special levies and a variable rate strata loan payable over approximately 10 years. The cost of the project has blown out, partly due to COVID increases in prices and other bits and pieces that are happening around the industry. With interest rates increasing, some owners are nervous and want to repay the loan and interest now. What are the likely costs and benefits of doing this if our loan provider allows it? And alternatively, can the interest rate on the loan be fixed? And we've also, at the same time, we had a comment come in from David in chat just going, how do these loans work when a particular owner can pay up front? Are they still hit with the same loan costs and interest, or can they just pay the levy? So maybe if we can maybe address both of those, Janine, at the same time.
Sure. Just to quickly answer that second one. No, you're part of a community. It's about what the owners corporation as a whole or your body corporate as a whole want to do. It's a majority vote, just like anything within your strata plan. If your owners corporation resolve to borrow, then all owners are jointly and severally liable. And that's because of several legislations, strata legislation, and also different legislations within the market. So no, we would not, for us, the loan is to the owners corporation. We're not dealing with individual owners. And for the other one, you could repay the loan early. We certainly allow early repayment. One thing to be aware of though is, yes, your strata loan interest rate has gone up, but so too has your mortgage rate interest. So you just, as a whole, your group would need to have a think about, well, how are we going to repay this early? Where are we going to put the remainder of this debt? Are we going to put it on our mortgage? Are we actually saving any money? Yes, the interest rate is lower, but it has still gone up by the same amount. Our strata interest rate has reflected changes in the cash rate. We don't actually base our interest rate on the cash rate. It is based on the 30-day bank bill swap rate, but that's mirrored the cash rate at the moment. So, with the rates going up, it's obviously a question we've been getting a lot. Can I pay this out early? Yes, you can, but have a think about if you're actually going to save any money by doing that. So are you going to put more, is it a financial pressure situation? Are you going to put more financial pressure on yourself by doing a special levy and paying this out early? It's something that you would need to discuss as a group, and it's, a particular scenario for each different owners corporation, depending on the financial position of people within your owners corporation.
Okay, wonderful, thank you. And Anna's just asked, I think this would be a quick one, what's the minimum loan amount that they can take out?
We don't have a minimum loan amount. We actually financed a $2,000 loan not very long ago. So, I mean, even I would be inclined to say maybe go special levy, but it was a 2-lot building. They were elderly owners on a very fixed income. They just didn't have the funds available. I mean, it was only $1,000 each. For some people, that's an easy special levy, but for these particular people, no, it wasn't. So we don't have a minimum. We don't have a maximum. We spoke about the Tamarama project. That was, a multi-million-dollar project. So we have no minimum and maximum. The way we work out what we can lend an owners corporation or a body corporate is based on the LVR, which is the loan to value ratio. And for that, we don't look at the insured value. We look at the market aggregate value of the building.
Okay, Mary had a question there. How does Lannock assess serviceability, and what is the downside payment default down the line if particular owners can't contribute to increased levies?
Okay, so the only time that we would step in is if the owners corporation as a whole aren't paying their levies. If you have individual owners who aren't paying their levies, then it's up to your strata manager would enact your arrears policy. So one of the things we look at in our credit assessment to assess whether we can lend to you or not is your arrears and the arrears policy. We generally find strata managers are very good at enacting the arrears policy and following up those arrears. If the owners corporation are to go into arrears for the loan, we always reach out as a first point of call to the strata manager. What's happening here? Is everything okay? If we can see that things are happening, in order to get back on track, then, you know, we just monitor it and leave it with the strata manager. Very rarely over the 20 years that we've been in business have we had to step in. And when I say very rarely, I'm talking about twice.
Okay, that's a fairly good stat.
Yeah.
Just a question from Jimmy about the non-renewal of insurance that we've sort of spoken a few times on, but he's just asking, are you seeing many non-renewals or massive premium increases due to certain types of uses or tenancies? And if so, what types of buildings or tenancies? Is that something you can really answer, Janine?
That's not really something we can answer. That's probably
that's fine.
A question for your broker. We are seeing insurance not offered to buildings, which is very tricky. Because then we can't help them. If you don't have insurance, we can't help you. And your strata manager generally will walk away too.
Okay.
So, yeah, that is something I would urge owners corporations to do. Attend to your works. If you've got an insurance issue, get it done. Reach out, have a chat with me and get it done.
Definitely.
You don't want to be in a situation where you're not insured. It's very messy.
And Lisa's just asked, does the manager have to declare existence of a strata loan taken in the OC certificate?
I think it is in the certificate. Yes. Yeah. So you would need to. It depends which state you're in, what the legislation is, but generally it's in the S184 in New South Wales. There's a loan there.
Victoria, she's saying. Sorry.
Yeah. I'm guessing you're thinking if you're selling a building. Yes, it's always declared. It would be in your financial records that there's a strata loan there.
Okay, thank you. So Elizabeth asked if we're currently completing the cladding works with the government using the 10-year loan, and the OC also has defects needing to be completed. Can they apply for another loan and have 2 loans outstanding at once?
Yes. Yes.
Okay.
So it would be outside of the project remediate loan, but there's been discussion, obviously, buildings who have defects sometimes have cladding issues, sometimes have defects or other things they need to attend to as well. So yeah, absolutely. When I do the presentation for your owners corporation, you know, let me know, let Hanson Youngkin know at the time they're doing their presentation, and we can absolutely work with you to have a complimentary loan at the same time.
Okay, wonderful. So can I just ask you too, just a quick question about the Sky building. How much role did the committee actually play? You mentioned there was a lady on the committee that really pushed that forward, and she was the sort of at the centre of getting the wheels in motion on that. So it's really great to have someone in the building championing something like that, an idea to push forward so that you can have those improvements come through in your building.
The committee have been extremely involved in that one. The committee, past and present, have been amazing at Tamarama. They've had the same strata manager with them, even though he's changed companies. I think he created his own company since the very beginning. So they've all worked together extremely well. And yeah, they've pushed the project through. They've been amazing.
And at what point do you step in, Janine? What point is it good to get Lannock involved in the process if you're thinking about doing something like that?
So for a big project like that, we're often quite involved from the beginning. Normally they've formulated a plan. This is what we want to do. They will have an idea of some costs. We are working with several others like that at the moment who are still in those planning stages. So we generally come in at the beginning once they've got an idea of what the costs are going to be. So we can explain to them what they need to do, how they can structure it. And then so that one, for example, was a very long project. I think Paul has been involved in that one, oh gosh, I would say 10 years.
Okay.
Yeah, and there's a couple of other very big loans that are doing something similar that he's been involved with for the same amount of time, if not longer. So with big projects like that, yeah, we're very involved from the beginning. Because we need to work with them to let them know how the finance works, how they can structure it. But then we obviously reassess right throughout the project as they get updated costs, things like that. For smaller projects, Alexis, who just commented, I've been working with that strata plan for a couple of years now. So generally, as soon as owners corporations or body corporates know what their costs are, they will come to us. I do have some examples of people who a strata manager will come to me and say, we're not really sure what this is going to cost, but we have to consider it. Can you give me options of say 500,000, a million, 1.5 million, just so we know, just so we've got a broad idea. So we're happy to step in at any time that it's comfortable for you. Sometimes owners corporations come to us right at the last minute and they'll say to me, Janine, we've had all of these costed, we're ready to sign a contract, we're going to a meeting in 3 weeks' time. Can you send us a loan proposal and the facility agreement to table at the meeting? So it happens very, very quickly.
Okay.
But our experience is it generally takes a couple of years in strata.
Okay, that's fine. And based on the comment that Alexis had put up there as well, so you're happy to go along to the meetings and have a chat with the committee at that point, yes, and the owners corporation or bodies corporate to explain the process. And
that's right. And the meeting for Alexis's building wasn't even a general meeting. It was just an owner's information session. So we're always happy to attend meetings to explain, because it's scary. It's scary. And sometimes a little bit of knowledge is a dangerous thing. People assume all sorts of things. It's good to be there just to answer those questions, to quell any of those fears. And generally people feel a lot better about it by the time we leave.
Excellent. Yeah, I know we get lots of questions about strata loans come through via the site, so I can imagine that that there'd be lots of questions out there in a large building from owners feeling comfortable with it. All right, that's excellent. Well, thank you so much. Do you have anything else that you'd like to share with us just before we wrap it up in total?
No, just that we are always happy to assist at any stage in the process. We are always happy to attend meetings. We're happy to chat with owners and committees. We're very flexible and are there for the strata sector.
Excellent. All right. Thank you so much. That sounds great. Thanks for joining us for this educational session. If you gained value from the information, please like this video. You can also engage further with LookUpStrata by subscribing to our YouTube channel or by being kept informed about strata news via our regular newsletters. Our subscribe link is listed in the description box below.